The artificial intelligence boom has become the defining economic story of this decade. From Wall Street to Silicon Valley, investors, executives, and entrepreneurs are all chasing the same dream: that AI will transform every industry, every product, and every business model. But as stock prices skyrocket, startup valuations explode, and capital floods into anything labeled AI, a growing chorus of analysts is asking the question no one in the hype cycle wants to hear. Are AI valuations running far ahead of reality? Let's start with the numbers. The S&P 500 has been driven almost entirely by a handful of AI-linked companies: NVIDIA, Microsoft, Apple, Amazon, Meta, Alphabet, and Tesla. These so-called Magnificent Seven now make up nearly one-third of the entire index's market capitalization. NVIDIA alone, the undisputed king of AI chips, briefly touched a $3 trillion valuation this year, surpassing Apple on the strength of demand for its GPUs. But here's where things get tricky. NVIDIA's revenue has indeed exploded, tripling year over year thanks to AI hardware demand. Yet many other companies riding the same wave aren't seeing the same fundamental growth. Microsoft's and Google's AI products are impressive, but the actual revenue impact is still modest compared to their overall business. Many AI startups attracting billion-dollar valuations haven't turned a profit, or even generated meaningful revenue. It's a familiar pattern, the same one we saw during the dot-com bubble of the late 1990s. Back then, investors bet that the internet would change the world, which it did. But they overestimated how fast it would happen, and underestimated how expensive it would be to build. Billions were lost as reality caught up with speculation. We're seeing similar warning signs now. The first red flag: capital concentration. Almost all of the gains in the current market are clustered around a few mega-cap tech firms. Outside of those giants, the broader market is flat or declining. This kind of narrow rally often precedes a correction, because it shows that investors are chasing momentum, not fundamentals. The second warning: valuation inflation. AI companies are being priced not for what they earn today, but for what they might earn 10 years from now. Price-to-earnings ratios for major tech firms have reached levels not seen since 2001. Startups with minimal revenue are raising hundreds of millions simply for having AI in their pitch decks. One venture capitalist recently joked, "If your startup doesn't have AI in the name, you can't even get a meeting." The third warning: the cost of AI itself. Training large models like GPT, Gemini, or Claude costs hundreds of millions of dollars. And deploying them isn't cheap either. Data centers, energy consumption, and chip supply are all straining under the weight of this growth. The reality is that AI is capital-intensive, and those costs aren't dropping fast enough to justify the explosive valuations. Meanwhile, corporate adoption is slower than investors think. While every company is experimenting with AI, few have figured out how to deploy it profitably. Surveys show that less than 20% of U.S. firms using AI have reported a clear financial return. Many projects remain in pilot phases, with unclear results and high maintenance costs. Then there's the revenue mirage. Many of the biggest AI-driven numbers we see, like productivity gains or AI-driven growth, are projections, not audited results. Tech companies are selling a story, not a balance sheet. Microsoft and Google, for instance, are counting on AI integration to drive subscription growth, but early user data shows mixed enthusiasm. Many customers are experimenting but not yet converting at scale. This disconnect between expectation and execution is exactly what fuels bubbles. When prices rise faster than profits, investors begin to trade on belief, not reality. And once belief cracks, the correction can be brutal. But here's the nuance. AI is real. The technology is transformative. It's already reshaping productivity, research, and automation. The issue isn't whether AI will change the world, it's how long it will take to do so, and which companies will actually profit when the dust settles. That's why some economists are calling this moment a productive bubble. Like the railroads in the 1800s or the internet in the 1990s, massive overinvestment may lead to short-term pain but long-term progress. The infrastructure being built, the data centers, chips, and software frameworks will likely form the foundation of the next generation of business. But that doesn't mean every investor or startup will survive to see that payoff. Even inside the tech industry, executives are urging caution. NVIDIA's own CEO Jensen Huang warned earlier this year that not every company will succeed in the AI race. OpenAI's Sam Altman has also acknowledged that the cost of scaling AI systems is unsustainable in the long term unless breakthroughs in efficiency arrive soon. And investors are beginning to take note. Some analysts predict that the next correction won't look like a full collapse, but rather a smart money reshuffle. In other words, capital will move away from hype-driven startups and toward the real infrastructure providers, the companies actually selling the picks and shovels in this AI gold rush. So what happens if the bubble bursts? If valuations correct sharply, expect to see three major outcomes. First, startups will face a funding crunch. Many AI firms currently depend on venture capital to survive. And if investors pull back, layoffs and consolidations will follow. Second, public markets could see a sector rotation, with investors moving back into undervalued industries like energy, healthcare, and traditional manufacturing. And third, regulators may step in faster than expected, especially as governments grow wary of tech dominance and speculative excess. But perhaps the biggest risk is psychological. The AI narrative has become deeply tied to national pride and corporate identity. Governments view it as a strategic race. Executives see it as a survival imperative. Investors see it as the next trillion-dollar wave. When that much emotion and capital are tied to one theme, corrections are rarely gentle. Still, not everyone is pessimistic. Some analysts argue that what we're seeing is less of a bubble and more of a repricing of the future. They say markets are simply assigning value to the inevitable transformation AI will bring, just earlier than the profits arrive. That may be true. But history shows that even when revolutions are real, markets tend to overshoot before settling back into reality. So, are AI valuations outrunning reality? Probably, at least for now. The truth is, we're still in the early innings of this transformation. AI will shape the next century just as the internet shaped the last. But the journey from hype to maturity is never smooth. There will be winners, losers, and painful corrections along the way. The best investors and the smartest companies won't chase the frenzy. They'll build quietly, focusing on sustainable value, not speculative momentum. Because when the hype fades and the bubble deflates, what will matter most isn't who shouted AI the loudest. It's who built something real,